Well, Happy New Year, everyone. It is January 12th, and we're just starting 2025. So I wanted to have a little conversation of what I'm watching this week because there's some new trends developing in 2025 that I think if investors get them right, could really set the stage for the rest of the year. The first one I want to start off with is something that we talked about in our most recent newsletter. We talked a lot about what's going on in the interest rate space because all the pundits have been wrong for the last year as far as what they're predicting. Here's a chart of the 10-year Treasury that we've shared in our January or Q1 2025 newsletter. And it just goes back over the last year of how the 10-year Treasury has been bouncing essentially between 3.5% and 4.7-ish. And we've been hypothesizing for the last 2 years that if the 10-year can stay in this Goldilocks zone of 3.5 to 4.5, which would be ideal, then investors can stay in investments that are interest rate sensitive, things like traded REITs, utilities, such, because they'll pay good income and they will perform well if you stay within that range. So here we are in the beginning of 2025. There's all kinds of euphoria about future growth policies with the Trump administration. And so now, as the Federal Reserve has cut interest rates 3 times for a full percentage point, as you can see here, we pointed out on the chart, interest rates have gone contrary to what people would think. And they've risen the 10-year from 3.5 to this week, they ended at 4.76. So the question is this rally in rates almost over, or is it just getting started? Because I'll tell you, if it's just getting started, most people's portfolios aren't prepared for that. In the reality, when you look at the bigger term picture, you can kind of see that don't get too nervous yet, because at the end of the day, we're at the high end of the range, and this rally started many months ago, so it's pretty mature. And this range, I think, is right now looks pretty solid. So this is something I'm going to watch very closely this week, is if rates can stay below 5%. The big concern is not if they spike above 5% temporarily, it's if they sustain trading above 5%. Then I think the wheels start to come off on a few things. So the jury's still out, but it's worth watching, because if this is the end of this rally and we can see some softness in rates and maybe a little sell-off back down towards 4%, 3.5%, which is not what anybody's expecting right now, so we should probably expect it. Then if you do see that, then possibly you have a situation where people don't have to get out of their interest rate sensitive items. So one thing I'm going to watch within our portfolios this week is one of the holdings we have is EPR Properties. It's something that we bought in the low 40s. We sold when it was up in the high 40s, around 46. We've started to rebuild a position. What's interesting is, if you notice, as I'm going to go back at this 10-year, if you notice in this last week or two, as the 10-year has pushed higher, something interest rate sensitive like EPR Properties, I would expect would have broken this low and pushed lower. So it's interesting that over the last 10 days or so, that as interest rates have gone higher, some of the interest rate sensitive items, the traded REITs, they've actually held some decent ground. So I'm going to watch that very closely, because there's been a pickup in volume that looks like buyer volume. So if things like EPR Properties can sustain a price of like 44, it might be a good sign. If it breaks below 44, then I may have to come out and make an announcement for our clients that we have to reduce exposure to something like this. It pays a great income, so it's worth giving it a little wiggle room. Another one I'm watching is something like Annaly Capital, another high income payer, but very interest rate sensitive. You can see here over this last 3-year chart, it's really just kind of been skimming along this $18 price. It tends to channel between 18 to 20. So what I'm going to watch here is, can it hold 20 and take a little bounce over the next couple weeks back towards 20? So can it hold 18 and bounce back towards 20? In order for that to happen, we're going to need to see the 10-year probably stay below 5%. So this is one of those times that you watch the 10-year as your tell. And if you can see the 10-year maybe back off of the current levels, maybe the interest rate sensitive stuff gets a bounce and it may turn out to be an opportunity and not a threat. We will see, and I will update you as that develops over the next few weeks, because it's definitely worth popping some popcorn and watching. The next big thing that nobody's talking about, but they will, is oil prices. So in our most recent newsletter, we put out this chart, goes over the last 5 years and shows you how oil prices have been compressing the last few years. We've been saying for the last year, year and a half, that once this pattern resolves, and it's resolving as we speak, we're going to have a new trend, either higher or lower in oil prices. And what's happened as a result of this is, as oil prices have kind of been stuck in this range the last 2 years between, let's say, $60 and $80 a barrel, the energy sector or the energy stocks have also been stuck in a range. Not a big deal because they pay great dividends, so you do get paid to wait. However, when everything else is growing, you sure would like, a part of your portfolio that's paying income to grow as well. And the energy sector has been kind of a disappointment. It's paid good income and it's just traded sideways. Had a horrible December. In December, as everybody was doing what we call window dressing, the energy sector had a little bit of a sell-off. But now, if I update just over the last 10 days, there's been a huge difference, because here you see oil has broken out of that pattern. It's broken out higher. Probably not good for signs of inflation, because oil prices and oil goes into everything we touch in the world. So with oil prices, if it's just a temporary spike, not a big deal. But if we have sustained trade of $90 or higher a barrel, I don't think the market's priced that in yet. So that could be a disruptor. What's happened in the energy sector since that breakout is the energy sector has had a nice start to the January, nice start to 2025, with a pretty healthy bounce off of a long-term support level. One word of caution I have here is I would feel more confident about the energy sector if the energy stocks were leading. If energy stocks were basically breaking out higher as oil was breaking, I'd feel a little more confident. However, maybe this is a game of catch up, that as oil prices push, you'll see energy stocks do a catch up thing here. So that's something that we're going to watch really closely this week. It's important for our portfolios because over the last 6 months, we have built a much larger exposure. We're overweight the energy sector now. So the more it can perform, the better we'll do. The other area, commodities, I'm watching this week is gold prices. In our newsletter, we highlighted with this little correction that gold's been in the last few months. Will it be another sideways move, or will it be something that becomes a deeper retrenchment? We've got our answer, it looks like, this week. It does look like gold is breaking out to the upside. Looks like it's fairly early in this move. We're pretty far along in this cycle of gold, especially when you look at it over like an 8 or 10-year cycle. So there's a really good chance here that this is worth watching, because sometimes these late stage cycles become those parabolic moves. We continue to have a pretty good exposure to metals in the portfolio. So I encourage people to watch what happens over the next few weeks in both gold and silver prices, because it could be pretty exciting. Hopefully not a disappointment, but it could be right now the price movement looks pretty robust. Last thing, stock market. Where are we, right? Starting off the year with a lot of euphoria. I've got to zoom out and look at the big picture, folks. And if you just look at this rally since the last big market reset, what's a big market reset? The Great Recession. So 08, 09, the last time we had a big sell off that was, generational. Since then, we have a pretty developed Elliott wave pattern where you can see 5 distinctive waves upward. At this point, the market rally has done everything it needs to. It can take a break for a year or two, and it would not hurt too many people, really, because we're dealing with so much profit. So I just forewarn anybody that's getting too risky right now, just realize the market's pretty long in the tooth. It can continue to go higher. Please read our newsletter. We talk about how irrational exuberance can last a lot longer and this market could go higher. What I'm watching this week as the tell is if I zoom into this market over the last 10 days, it starts to look interesting because really how I'm viewing this is if the S&P 500 can sustain trade above 58.75, this basically little breakdown that we had on Friday, if we can get back above that, the bulls are still in control and this rally could continue on for a while. However, a breakdown below this 5,800 level then starts to look like we could get a deeper correction down to 5,200, which from a percentage wise is not that big of a deal. But at that point, we'd want to kind of regroup. So with that, and because a little extra caution never hurts, because we're in such a mature part of the market, and this particular breakdown could be minor or it could develop into something more major. But just because we're so long in the truth that we have started to hedge our equity risk. We had things in the portfolio like Amazon, Google, ASML, Microsoft. And if the market goes through a correction, of course, those holdings will as well. So we have temporarily started to hedge some of that within the portfolio. So if we get a temporary correction, we're hoping to keep the portfolios as buoyant as possible. So those are the things that I'm watching this upcoming week. What happens in interest rates? We'd like to see them back down, and we'd like to see the interest rate sensitive investments like traded REITs stay above their most recent little pivot that they had. Looks like oil is breaking out to the upside, so that's concerning for inflation in the future. And hopefully that's good for the energy holdings that we have within the portfolio. Gold looks like another one. Gold and silver look like something we definitely want to keep a close eye on because those moves, if they do become parabolic, could be pretty robust. And parabolic means you're coming to an end. It doesn't mean you want to chase it. It means you want to, look for ways to take profits when that starts to happen, if it starts to happen. And then when it comes to the stock market, we're just going to watch real closely because we are due for a correction. And if that starts to develop, we want to make sure that we can hedge it and take advantage of it. So folks, that's what we're looking at this week of January 12th. I'll give you another update as these things develop in the next week or two. We have a new update coming out, so keep an eye out for our newsletter that will be released this week. And if everybody would also just wish my great mother a happy birthday. It's her birthday week. She's been the best mother I could ever have. So if you all could just give Barbara McFadden a little happy birthday wish, I'd appreciate it. Until next week, folks, take care.